What if you could pull in a massive dividend yield from an ETF without giving up all of the growth? That's the dream, right? Most of the high yield covered calls pay a good monthly paycheck, but you never see the account balance go up or you even see it go down with NAV depreciation. Now you're earning income, but you're not actually building wealth. So going through the world of income ETFs, I think I finally found one that plays an entirely different game. It promises a strong monthly income and it also has a shot at real growth. So we're going to be breaking down this one-of-a-kind ETF that really turning heads with a 9% plus dividend yield, which is kind of crazy. Seeing how it works, showing you exactly how it's different, and is it too good to be true, or could it be the real deal? Now, when we start looking at the elephant in the room, it is the high yield trap. Covered called ETFs over the last couple of years have absolutely exploded in popularity. They promise something that investors absolutely crave: steady monthly income in a world that is very unsteady. Now, the idea is simple. You sell your covered calls against the portfolio, you collect the premium on those covered calls, they pass that income on to the stakeholders. Sounds super easy, right? The problem is most of the funds are trading away all of the growth potential that we see in an ETF. Hey, QYLD, for example. It is the poster child when it comes to those high yield ETFs. People love the 10 to 12% payout that it offers until they realize the share price has been bleeding out over time. When you pull up a long-term chart, you'll see the downward drift that is eating away on the principal that you have in that ETF. The exact same thing can be seen when we look at the JEPY or the JEPI, JP Morgan's gigantic income ETF that we've seen. A lot more stability, managed a lot better, have tens of billions of dollars in there, but even JEPI has the trade-offs. It's built really for consistency, not keeping up when we see a really strong bull market. When the S&P is on a rip like we've seen for the last 3 years, JEPI's cap and really capping that upside, meaning the growth is going to be left behind. Can be very frustrating when you're looking for growth in income altogether. Great for income, but you can watch your portfolio shrink, or the portfolio actually grows, but you're not getting that income. It is like being stuck on a treadmill and nothing is even changing. So the big question is, can you have both of them? Can we have a high monthly income and meaningful growth for years? The answer was kind of questionable or even no with a lot of ETFs. Until now, I think that has finally changed. Now, this is one that I added to my income portfolio that we've seen. Brings us to today's ETF, which is the NEOS S&P 500 High Income ETF. The ticker symbol on this is SPYI. Now, this fund has been quietly building a very loyal following, including myself. Once you understand why it works, you'll see exactly why. Now, the mission is simple: deliver a high income, preserve growth potential, and do it in a tax efficient way. So it is really interesting to see how it's growing. In 2025, it has floated around 11 to 12% paid monthly, very high when it comes to the income generation. Magic number isn't really just from the yield, it is from the structure of this ETF itself. Unlike many covered calls that we see for those ETFs, SPYI strategy is engineered to solve the exact problem that we're seeing with all of these funds, the QYLD and the JEPI. So let's look at exactly how this works. When it comes to covered calls, here's a quick refresher. When you own a stock, you're selling someone else the rights to buy it at a certain price. You collect that premium up front. That is how they're generating income. If the stock stays below the price, you keep both the shares and you keep the premium. The thing is, if the stock takes off past the strike price, you are capped on the upside, which in a bull market like we're seeing, absolutely you're losing a lot of money. That's the trade window off. You're giving up income now, or you're getting income now for the growth that you're giving up. Most covered calls like the QYLD do this with 100% of the ETF's holding. Very reliable income, but it locks you out of any large market rallies that we do see. SPY, again, takes a much smarter route. Instead of selling covered calls on individual stocks, it sells options on the S&P 500 itself, known as the SPX options. First difference, the secret sauce is the called spread. Now, the SPYI sells call options to generate income, just like we see on all the other ones, but it uses a portion of the income to buy back some of the upside that we see through the call options that are further out of the money. So you're actually using some of the portion and the portion of the income that is revenue generated going back into it itself. So think of it this way. The cap gains at, let's say, 5%, but then the protection kicks in with the market rallies beyond 10. So you collect big monthly income and you're getting to participate when the market takes off. So think about that. It is not a fully unlimited growth because you still have the options, but it is a very clever middle ground. And this is where the SPYI really does shine. It is actively managed. This is important when it comes to an ETF, meaning the managers can adjust the position that we see in there with volatility and market trends, which passive funds will not do. And here's the kicker to all of this: it is tax efficient. So when we start looking at the SPYI, the IRS classifies it as a Section 1256 contract, meaning profits are taxed at long-term and short-term, no longer or no matter how you do hold them. Usually means a lower effective tax bracket for individuals when it comes to ordinary income. And of course, it pays it out as a return of capital, meaning it is deferred until you actually sell the asset. My plan is to never sell the asset in the entirety. So here you've got high income, you have a much higher growth potential and better tax treatment all in one ETF, which is super rare to see. Very cool on paper, but how does it actually work when we look at the results? Since the launch of late 2022, it has been consistently over and outperforming JEPI in total return. That means the price plus the dividends that are reinvested. JEPI has been a smoother ride, not as many ups and downs, but SPYI has edged because it's keeping more of that market upside. Now, against the S&P 500, of course, it has been on a massive bull run that we've been seeing. So capped upside and beat SPY in a 25% rally. What's impressive is how close this ETF has actually stayed, delivering a 11% total return, while the SPY itself did 11.4%. So it's pretty impressive again how it is. How does it compare to the QYLD? Not even close. The QYLD's price has been sliding for years, and this has managed to hold its ground. But in addition to the income generation, it has actually increased in value. So you're getting strong monthly income and preserving the capital or getting that appreciation combination most investors really dream about. But of course, there is no perfect ETF like we talked about. First, you're still capped on the upside. If the market is absolutely roaring, the SPYI will underperform the S&P 500, and that's the trade-off for getting the monthly income. Second is, of course, the hedge. If the S&P 500 drops 20%, SPYI is going to go down with it. Income is really softening the blow, but the principal is still at risk with the ETF, and the expense ratio, it is a 0.68. When we start looking at actively managed funds, it is way higher than the 0.03 of, let's say, the S&P 500 funds with the VOO. And of course, it really depends on volatility. If the market is going sideways, if the market is calm, the option premium shrink. That means smaller distribution of income. And so the yield on there can fluctuate. But of course, you cannot accept any of those trade-offs. Your capped upside, your active management costs, and the volatility swings might be looking at getting into something else. So what exactly does it mean? So when we look at the SPYI, it is truly one of a kind when it comes to covered called ETFs. I'd say yes, if you want to bridge the gap between those juicy incomes and the returns we're looking for long-term growth, there's nothing better in the space right now. You get exposure to the S&P 500, which a lot of people are saying could be overvalued, but it has a strong monthly cash flow, smart option management, and a real tax advantage all in one ETF. Now, of course, it's not a silver bullet for many traders that are chasing quick gains or going to be trading out of this on a regular basis. It's not going to be the one for you. But if you're looking at income-focused investors, especially those near or in retirement that need the revenue generation, it is a very perfect balance. So what do you guys think of this ETF itself? Is SPYI the next generation of investing? Or is it something fancy that is really just going to be a good marketing concept? Drop a comment below so I know exactly what you think about it. And hey, if you found value in the video, definitely hit the like button. Subscribe to the channel for more of the deeper insights into income investing, and I'll catch you in the next one.